Welcome back, everybody, for another YouTube video. I am running slightly behind schedule today. At the time of me recording this, it's currently 1 p.m. Usually the videos are released at 1 p.m., but I'm going to be releasing it an hour later. I've had some things to deal with, nothing major, just, everyday life things, property issues and stuff like that. But we are going to be making up for it. This is going to be a pretty interesting video because yesterday... And this is, and actually in this video, we're going to teach you the importance of watching all markets. And you guys know we watch the traditional markets as well as the crypto markets to really help us navigate what's going on in our market, the crypto space, and kind of where it finds itself in the whole macro picture. But yesterday we had the FOMC, or some minutes released from the Fed, and we're going to be looking at that because I've expressed and I've been expressing my distaste for being on the side of the general public in regards to everyone's very bearish now, everyone's expecting the same thing, and I am a lot less bearish down here than I was at any point on the way down. Last year the best trade really that we made was getting out the markets, and I will be looking in 2023 to reallocate, but I do not want to jump the gun in regards to that decision. And I think that the FOMC are still talking a very tough talk. I think a little bit of it's bravado. They kind of know what they're doing is somewhat working at the moment, and they don't want to ease off too soon, but they also don't want to over-tighten too much. So a lot of what they're doing now is talking the markets down. So we'll be reviewing this. But actually, we knew what was coming in the FOMC from watching and doing cross-market analysis because we are watchers, and I'd shared this at the start of the week with my Patreons. Anybody that's interested in that, there's a link in the description. We were watching the federal funds rate. And we were essentially saying, that's interesting, isn't it? That, at the start of the year, when markets reopened, the Fed funds rate went right down in terms of the 30-day Fed funds futures, which means that actually what the Fed are looking to do in terms of rate hikes is going up. So these are things you need to pay attention to, because that kind of signaled that, okay, maybe the Fed are actually going to be a little bit more aggressive than what markets are pricing in, based on the futures market for speculating on the federal funds. And actually, maybe they're going to be a little bit more aggressive for a little bit longer. And we did do a whole analysis or a whole video on looking at where Fed funds is likely to go and in what time period. And we looked at the 2-year yields to kind of predict all this. But markets, January, we've spoke about the January effect. We spoke about a lot. These market updates really for you guys in terms of navigating this treacherous sort of or these rocky waters are very crucial. We spoke about a lot. We spoke about the January effect. December you have a lot of tax harvesting. People sell at the end of the year. New tax year, straight in America. Certainly they'll buy again. And this is so that they can sort of take that loss. They can ride against whatever taxes they make in the year. And so on and so forth. But then they'll buy again. So we've had a little bit of that, but it hasn't been as strong as expected. And actually, it's been pretty brutal to the downside. But yesterday, the stock market had quite a good day. Bitcoin had a good day. Things like Ethereum did... I better take all my drawers off here because I never know what I'm going to find on my charts. Things like Ethereum did very, very well. Binance did extremely well. It was up nearly 6% yesterday. And Bitcoin did okay. But we're still very much in this range, and I want to just stress that even though we're a lot less bearish down here than we have been previously, that doesn't mean we're bullish. That just means that the risk to rewards to being an outright bear, like everybody on Twitter now is, and everybody on YouTube now is a convicted and a convicted. They're a bear with conviction. We aren't that at this point. We're still bearish, but our big grizzly outlook on the markets is somewhat waning. We're playing it by ear now, and we're looking for an opportunity to reinvest and to start accumulating cryptos, because you guys know I'm a believer in the crypto space. And I think that for me, the real risk right now is more that sort of Lehman's moment, that March 2020 moment, that capitulatory event that takes place at the yield curve predicting, and I think we're very much set for. And I'd like to avoid that, but at the same time, you're speculating on something that may or may not happen, right? So I like to deal with what's in front of me. I like to keep certain scenarios in mind. I have a variety of scenarios how I think markets play out, and I go for the most probable one. So we're still not an investor in this market yet. But we are a lot less bearish than we once were. And we are doing daily Bitcoin technical analysis updates. we've got it literally the day's moves perfect since the start of the year. But then again, we're only 5 days into the year. But feel free to look out for those when that comes out. But let's take a little bit of a look about what came out of the Fed's minutes. We can give a short summary. This is Good Gavin's Twitter. I like to follow him because I'm pretty sure all this guy does is sit on Bloomberg Terminal and then report it on Twitter. In fact, I'm positive that's all he does. So he's a very good guy to sort of follow if you want any kind of a decent macro take. And then we're going to go over a little bit of sort of macro news. And I'm also going to be reminding people about what we reviewed at the end of last year, which was Grayscale's 2023 outlook. Not Grayscale, sorry. BlackRock's 2023 outlook, and what they said would need to happen in regards to getting inflation back to where the Fed want it, and that's a 2% fall in GDP, which is colossal and would mean more pain across the board. And I still do think that that's the play. You know, this is not an environment where I think a rally gets supported, and there is a case where a rally does happen and then something happens to support it. But as of right now, we still expect more downside as a liquidity crunch continuing to crusade and purge all markets. I also want to cover this. Amazon says it's going to cut over 18,000 jobs more than initially planned. This is from Gavin again. Amazon lays off over 17,000 workers, or to lay off. So I don't know who's right and who's wrong here. Amazon just officially confirmed, and so on and so forth. They are going to start this essentially on January. And actually, we did some real good analysis on the labor market and in relation to the stock market. And what we actually have said... Shall I do it? I'll do it for you. Go on then, guys. I'll do it. I'll do it. Okay. What we at? No, so this isn't what we want. Give me, guys. I'll do it for you. Again, we've done it 1,000,001 times. Follow this channel because nobody else gives you this sort of stuff because they just simply don't understand it. It's literally that simple, guys. They don't have a clue what they're on about. There is some people that are well worth following, like the Market Sniper and the Crypto Sniper, Francis Hunt. Absolute demon when it comes to demon's not the right word, but absolute, very, very accurate. So this is unemployment, and the reason this Amazon news is significant, and I did say I'd make up for not bringing my video out a little bit late. This is unemployment, and when unemployment's at a low, stock market's at a high. Unemployment at a low, stock market at a high. Unemployment at a high, stock market at a low. So unemployment's in green, unemployment at a low point, stock market at a high. Unemployment at a low point, stock market at a high. Vice versa, unemployment at a high, stock market at a low. We're still at a low point for unemployment. So if employment skies up again, which sort of ties into our demand-killing event, which is the yield curve predicting, which is what we're saying, this means more pain for markets, and we're starting to see continuation in job cuts, which means unemployment goes up, which means stock markets come down. Analogy and stuff that people really don't look at. It was actually the sniper that showed me that. And this is what we're expecting. So this is why even though we're not as bearish as we have been previously, like everyone on Twitter now is, are convicted. They're in the bear parade. We don't want to be that bearish, but we also want to be very mindful of the situation. And the Fed came out yesterday and very much said, and I won't read this whole article, I'll summarize from Gavin's Twitter. Fed official generally saw inflation risk as a key factor. Fed warns of a unwarranted easing in financial conditions. Or Fed wary. So they're basically saying that they don't want to, ease the monetary policy because they ultimately don't want to make a mistake like what happened in the 70s or prior to that. And have more of a persistent inflation, and then they're in this kind of no man's land stagflationary environment. And the FOMC members agreed rate cuts shouldn't happen in 2023. Wow. So they agreed that we're not going to get any rate cuts. So that means harsher conditions for longer. And actually, they're set to continue to raise interest rates. But we showed you that at the start of the video. And also, just to really drill things home about the macro environment, this is what BlackRock are looking at, 2% fall to bring inflation back in line. So the CPI print is going to be very interesting next week. There's lots of things going on. Again, this isn't just a US-specific thing. We also have lots of chatter in the UK. And across the board, the ECB, everywhere, talking about a recession that's going to be a pretty nasty one caused by interest rates. This is the harshest hiking cycle I think we've had since the 70s, potentially. And that means paying for markets. And this is why we've stayed out the markets, because we've understood the macro conditions. Whilst everybody else has been, not everybody, lots of other people on YouTube just have simply, and still some of them even failing to grasp it today. When you have, bringing up the M1, we could bring up the M2, we'll just use M1 for argument's sake. Free-flowing money and money pumped into every facet. Things go up in price because they're denominated in that money that's being printed and inflated. When you have markets contract, the opposite happens. It's that simple when it comes to investing, and please let that be the key takeaway you guys take with you from this video. I'm going to love and leave you on that note, guys. You enjoyed the content, like, always appreciate it. So, a comment, and I'll see you all in the next YouTube video. Thanks a lot for watching, ladies and gents.